Open your retirement account and look at the number.
It appears stable. It appears allocated. It feels like capital waiting for your decision. But some portion of that number may depend entirely on a balance sheet you have never seen, do not control, and cannot access. Because your retirement is not sitting in cash. It is sitting in structures. In February 2026, Blue Owl Capital, a firm managing approximately $307 billion in assets, stopped redeeming quarterly withdrawals on one of its funds, while simultaneously selling $1.4 billion in loans to 4 North American pension and insurance investors. Not on a public exchange, not into a transparent order book, through negotiated transfers between institutions. The CEO said there were no red flags. Bloomberg said there was one. Both described the same transaction. The system did not collapse. It did not panic. It operated exactly as it was designed to operate.
To understand why that sentence matters, it helps to understand how private credit became central to modern finance, and why its growth was never really optional.
After 2008, regulators made a deliberate decision to reinforce the banking system. Basel III raised capital requirements. Dodd-Frank introduced stress testing and expanded compliance frameworks. The objective was stability. The reasoning was sound. If banks carried more capital against their exposures, the core of the system would be less fragile.
But capital requirements do not remove risk from the economy. They change the economics of holding it. Long-duration loans, higher yield exposures, and middle-market credit became more expensive to maintain on regulated balance sheets. Banks did not stop lending entirely. Their capacity in specific segments tightened. When demand for credit remains constant while regulated capacity declines, the credit does not disappear. It relocates.
Private credit became the new carrier. Global private credit assets under management quadrupled over the past decade, reaching $2.1 trillion by the end of 2023. By late 2024, that figure had reached $3.5 trillion, with capital deployment up 78% in a single year. That growth was not enthusiasm, it was substitution.
The shift showed up most clearly in leveraged buyouts. In 2021, private credit financed roughly 20% of large buyout transactions. By 2024, Standard & Poor's Global and Preqin data placed private debt's share of global leveraged buyout financing at 77%, the highest annual share since at least 2015. In early 2025, that figure reached 83%. The underlying corporate demand for financing did not change. The institutions carrying that exposure did. At the Economic Hub of Dallas, U.S. Treasury Secretary Scott Bessent described this directly. He called private credit's rise regulatory arbitrage, the product of a post-crisis framework that made lending inside regulated banks structurally harder. He said over half of small and community banks have disappeared, not because they were managed poorly, but because the rules made their model economically unviable. That was not analysis from an outside critic, that was a structural admission from the person overseeing US financial policy. Risk didn't disappear after 2008, it relocated. Many discussions frame private credit as a parallel system, something that grew independently alongside regulated banking. That framing is incomplete. Private credit did not grow around the banking system, it grew through it. Federal Reserve researchers have documented bank credit lines extended directly to private credit funds, short-term liquidity facilities provided by regulated banks to funds holding long-duration, illiquid loans. Banks constrained from holding certain loans directly began financing the vehicles that hold them instead. The pipes between the regulated and unregulated sectors were never cut. They were rerouted. This creates structural interdependence that becomes relevant under pressure. Private credit funds rely on bank liquidity to manage timing mismatches between capital calls, redemptions, and loan repayments. Banks, meanwhile, maintain indirect exposure to the credit market through the funds they support. When conditions are stable, This loop functions quietly, invisibly. When pressure builds, both sides experience it at the same time, not separately, together. That interconnection is exactly what makes the next part matter. In February 2026, Blue Owl did not primarily rely on those bank lines to address withdrawal requests. Instead, it transferred $1.4 billion in loans directly to institutional balance sheets. That action reduced the fund's immediate liquidity pressure. It did not remove the underlying credit risk from the financial system. The loans remained, the borrowers remained, the exposure remained. Only the address changed. Risk doesn't disappear, it relocates. When Blue Owl stopped redeeming quarterly withdrawals, it activated a contractual mechanism embedded in many private credit structures, known variously as a redemption limit or a gate. Understanding what that mechanism does and what it cannot do matters more than the headline. Private credit funds are typically organized as closed-end vehicles. Investors commit capital for multi-year periods, often 5 to 7 years, or even longer. The underlying loans frequently carry similar durations. They are privately negotiated agreements, not publicly traded securities. There is no daily exchange price. There is no deep, continuous secondary market that can absorb large volumes quickly. When investors request capital back, the fund cannot simply sell the loan into a transparent order book. There is no such book. It must either wait for loan repayments, access credit facilities, or locate a specific buyer willing to assume the exposure at an acceptable price. A redemption limit does not generate cash. It delays the need for sale at potentially distressed prices. It gives managers time to locate buyers or deploy internal liquidity tools. That distinction matters in practice. Investors agree to these terms at the time of commitment. They are disclosed. They are documented. They are part of the design, not an emergency workaround. But expectations are not static. When volatility rises or capital needs change, investors may seek liquidity from structures built to restrict it. At that moment, the operational question becomes concrete. Where does the cash actually come from? In this case, the answer was a private transaction. 4 institutional investors absorbed the loans at 99.7 cents on the dollar. The transaction cleared because specific conditions aligned: available balance sheet capacity, regulatory room, pricing agreement, and timing. Those conditions are not permanent features of any market. They are circumstances that exist until they no longer do. Liquidity is not guaranteed by contract. It is enabled by capacity. Private credit is often described as stable. On quarterly statements, values appear smooth. There are no daily price swings to unsettle beneficiaries, no headlines about drawdowns, no uncomfortable numbers to explain. That perceived stability is frequently cited as a structural benefit of the asset class. But valuation stability and liquidity are not the same thing. Private credit assets are valued through periodic appraisal models and comparable transaction data. That process generates a number. It does not generate a buyer. Without a buyer willing to transact at that number on that day with that balance sheet available, the valuation remains theoretical. Liquidity isn't a property of the asset. It's a property of the buyer. If the buyer hesitates, the number on your statement becomes the opening position in a negotiation. When Blue Owl sold loans at 99.7 cents on the dollar, that figure reflected an agreement between sophisticated institutional buyers and sellers at that specific moment.
It did not mean the asset was liquid in the everyday sense.
In stressed conditions, where buyers grow cautious, where capacity tightens, where institutions approach regulatory thresholds, liquidity compresses. Transactions slow, pricing gaps widen. The mechanism that operated invisibly under normal conditions becomes visible under constraint. According to AIMA research published in late 2025, approximately 80% of global private credit assets sit inside closed-end structures. Semi-liquid vehicles rely extensively on liquidity management tools, gates, redemption queues, transfer mechanisms, because the asset-liability mismatch is built into their design. None of this is hidden. It is structural. The illusion dissolves, not through collapse, through limitation. Return to your retirement account. The number you see represents layered exposure. That exposure may include private credit allocations through pension funds, target date vehicles, insurance-linked products, or broadly diversified investment structures. You may not have selected private credit directly. The exposure may have entered your portfolio through institutional allocation decisions made at higher structural levels, each layer operating within its own defined constraints. The chain has a specific order. Banks operate under externally enforced capital ratios. Their limits are visible and regulated. Private credit funds operate under contractual mechanisms, gates, redemption queues, transfer provisions. Insurance companies are bound by capital treatment rules that define how much illiquid credit they can hold. Pension funds allocate according to long-term liability matching strategies, with review cycles that run quarterly or annually. Each layer has a function. Each layer has a limit. Pressure moves toward available capacity. It does not stop where flexibility exists. It accumulates where flexibility runs out. At the Economic Club of Dallas, Treasury Secretary Bessent stated,
"This administration, led by Treasury, is committed that the individual investors will not become the dumping ground for residual."
That is a policy commitment, made in public, on record. It acknowledges that the possibility is real enough to require a statement against it. It is not a confirmation that the structural pathway is closed. Your retirement depends on someone else's balance sheet, not because of wrongdoing, not because of misrepresentation, but because liquidity conversion requires institutional capacity. When that capacity is available, transactions clear quietly. When it tightens, the conditions that made those transactions possible become visible, only by their absence. Risk does not disappear. It relocates. Blue Owl did not fail. It responded to liquidity pressure, using mechanisms that were always embedded in its structure. The redemption limit, the loan sales, the institutional transfers. None of these were emergency improvisations. They were design features, operating as intended. The system did what it was built to do. Private credit did not eliminate the risks that migrated off bank balance sheets after 2008. It redistributed them across layered vehicles with longer durations and delayed liquidity. The objective was resilience. The byproduct was distance. Distance between the asset and the ultimate holder. Distance between valuation and tradability. Distance between what a quarterly statement shows and what the underlying mechanism actually requires to convert that number into cash. That distance closed recently. Not through crisis, through the ordinary operation of the structure. When liquidity depends on someone else's balance sheet, the stability you see on your statement is linked to their capacity. And capacity in every financial system is bounded. Structures do not eliminate risk. They determine where it rests.